You guys, welcome back to the bumpy road to $10 million. This is the March 31st, 2026 portfolio update, 1 month into the Iran war. And as you can probably guess, our portfolio was down materially as of this date. Before we move on, a reminder that this video is not financial advice, and when investing, you can lose everything. So please always do your own research. So 3 months into 2026, as of March 31st, the stock market had declined and our portfolio had moved down significantly. SPY was down by 4.6%, and our UPRO and SPXL ETFs were both down by just over 16%. Before we move on to the change in option prices, let's discuss the SPXL options quickly. The volatility in early March had actually caused option prices across the board to increase by quite a bit. And remember, our SPXL options are expiring relatively soon in July. So I took the opportunity to sell the SPXL July 2026 puts at a relatively high price, around 10% higher than I had bought them at, and use the proceeds to buy SPXL puts maturing in January 2027 with a strike price of $50. So as a result of this trade, both my SPXL and UPRO puts have the same maturity. Ultimately, by doing this, we have avoided rebalancing the SPXL put options when they are worth nothing in July. And another way of saying this is we have extended the maturity of the puts at no cost. And to put some numbers behind this, I had bought 18 put option contracts at a price of $2.15. And in an absolute unlikely worst case scenario where SPXL goes to zero, we still get $90,000 back. Remember, this is just the strike price of $50 multiplied by the number of put contracts times 100. So after this trade, let's look at the change in option prices since we bought them. As you can see, the options have skyrocketed in value. Both were up over 30%. And this is the point. The options are there to protect us in the event of a market crash. While a 4.6% decline in the SPY is nowhere near a crash or even a real correction, it's good to see the options behaving like we expect them to. And you can only imagine how high these would go, for example, if the SPY crashed by 20%. Now, if we look at a hypothetical portfolio, just like last time, where we had invested $10,000 at the beginning of the year and added $1,000 on February 28th, this is what the portfolio would look like. The options increased in value by a lot in percentage terms, but they are a small part of the portfolio, so the dollar value increase is quite minimal relative to the ETFs. And if we do a simple return calculation at the bottom, dividing the $9,319 portfolio value by our invested capital of $11,000, the portfolio return is just below 15%. Now, a 15% decline in portfolio value seems like a lot, and it is only if you need the money. I will reiterate at every opportunity that we are invested for the long term, so we don't care where the portfolio value is today. And this is just an opportunity to buy shares at 15% cheaper. And if the world goes to hell and our ETFs are literally worth zero, we would still be well protected by our put options. So in case you were panicking, everything is just fine. And maybe we should even consider monitoring our portfolio on a quarterly rather than monthly basis for peace of mind. Definitely do not check the prices every day, no matter what you do. That's a recipe for disaster for your mental health. So we'll wrap it up for today. In a few days, we'll also do the April portfolio update. And spoiler alert, the market and our portfolio will have both recovered by then, unless something dramatic happens over the next few days. Hope this was helpful. Thanks for your time, and see you on the next one.